Hello everyone, this tutorial video is made by Bình and Hiền about accounting principles and concepts. 5 accounting principles and concepts will be mentioned in this tutorial video include accounting entity, matching principle, monetary principles, historical cost, and finally is full of disclosure. First 3 principles and concepts will be presented by Miss Bình.
Okay, now is accounting entity concept. This concept is related to the entire business model. Under accounting entity concept, every entity can be separately identified and accounted for. A business can take one of 3 legal forms: proprietorship, partnership, or corporation. It is very important to understand the form of the business because sole proprietorship and partnerships are not separate legal entities. The business owners are often the managers of the business enterprises, so it is easier to confuse the business and private transactions. It is more clear in the case of a corporation because a corporation is a separate legal entity and therefore the owner's transactions are separate from the entity's account. For example, the owner of the business may use his money to buy a vehicle if the vehicle is intended for personal use, meaning the owner uses it, and the purchase of the car is recorded in the business account. If the vehicle is purchased for business use, such as in transporting the goods to the customer, then it is recorded in the business account. The car will be recorded as an asset, and the money owner used to buy the car is recorded under owner's contributed equity. Similarly, if you use your money to buy a machine for your family, the purchase will not be recorded as an asset. But if you are running a bakery and you use your money to buy the baking machine for your business, in baking and selling cakes to the customers, the purchase will be recorded as an asset and the money will be recorded in owner's contributed equity. Now we move to matching principle. This principle is related to the accounting process. This principle says that the costs of doing business are recorded in the same period as the revenues they help to generate. It means that where the expenses result directly and jointly from the same transactions as the revenues. For example, the cost of services provided or the cost of sales, expenses should be recognized on the basis of a direct association with revenues. The examples include cost of goods sold, salaries expense, insurance premiums, supplies used, and others. These expenses are required or needed to generate the revenue for the business. Now is monetary principle. This principle is related to transactions. The principle says that an economic entity's accounting records include only quantifiable transactions. This may seem obvious, but it has important implications for financial reporting. Only transactions and events that are capable of being measured in monetary terms are recognized in the financial statements. Certain economic events that can affect a company, such as hiring a new CEO or introducing new products, cannot be easily quantified in monetary units and therefore do not appear in the company's accounting records. Certain important information like customer satisfaction is important to every business, but also it is not easily quantified in dollar terms, and therefore it is not reported in the financial statement. And because the exchange of money is fundamental to every business, especially when you do business in different countries with different currencies, it makes sense that we measure our business in terms of money, and accounting records must be recorded using a stable currency. Businesses in the United States usually use the US dollar for this purpose.
Thanks Kim to provide for us very useful information about the accounting entity, matching principle and monetary principle. Next, historical cost and full of disclosure of information will be examined by me. Historical cost principles state that the business must record and account for most assets and liability at their purchase or acquisition price. In other words, business have to record an asset on their balance sheet for the amount paid for the assets. Liability are also accounted for using the historical cost principle. When bonds or other debts are issued or received, they are recorded on the balance sheet at the original acquisition price. Next, advantage and disadvantage of historical cost will be examined. Advantage of historical cost is relatively easy to determine and can be verified. There are some disadvantages of historical cost. The historical cost principle is a trade-off between reliability and usefulness. The asset cost of price is then never adjusted for change in the market or economy and change due to the inflation. I will give you guys detailed example to understand clearly. HP Restaurant was formed in 1990. It purchased a building soon after in 1990 for $100,000. So after 20 years, HP is still in business. The original building is still on the balance sheet for $100,000, even though the current fair market value of the building is well over $300,000. HP will keep the building on its balance sheet for $100,000 until it is either retired or sold. Next, the full of disclosure principle require company to provide the necessary information so that people who are accustomed to reading financial information can make informed decisions concerning the company. The financial statement should disclose all the relevant and reliable information so that the information may be useful for the user. The disclosure should full, fair, and adequate so that the user of financial statement can make correct assessment about the financial performance and position of the enterprise. This is the end of our tutorial video. Thank you for listening and please leave your comment about our video.